Welcome to the Daily Update, where I'll go over the action in the market for Thursday, May 16th, and then we'll see how things look for Friday, May 17th. After a positive open, we went up, we hit resistance, ended up coming back down, saw a bit of a down day right now. Just looks normal to this point. Things are still positive, but we want to keep an eye on this. We want to see selling into strength, or if we see weakness, is that selling going to pick up and become even more intense? We always want to keep an eye on that, but we're still looking positive for right now. The market had Wednesday was a monster day. Tuesday was kind of a baby monster day as far as upward move. We've switched positive and have been positive now. But at the same time, this move up in the market has caught a lot of people off guard. They didn't think it was going to happen. There were a lot of predictions that we were going to go lower. Well, we ended up going higher. So when we start to see a little bit of weakness, we want to keep a real close eye on things in case it develops into something more intense. Right now, no. Everything is still looking okay for the time being. We did set all-time highs on an intraday basis, but since we closed down, we did not have all-time highs on a closing basis. Before I get started, I am making an announcement now. Starting on Monday, June 3rd, I will be locking down the videos. That means that they're not available to the public until after the market closes for that day. So this is Friday's video. If we were in this period now, right after the market closes on Friday, that's when it would switch over and become a public video. The weekly videos that I do, they're still going to be available as posted. Also, if you want to have early access to those and not necessarily become a member in the program that I have, that will be $19 per month. And if you count out the number of days, it's about 20 days or so each month. So it's a little bit less than $1 a day. Try to decide if you think it's worth it or not, or if you just want to keep it to the point where you watch the videos after the close. If you are a member, and membership will be $97 a month, and there's a whole lot of things that are involved in that program, you won't have to pay an extra $19. That will be included as part of the membership. If you have some feedback, either feel free to leave a comment if you'd like. If you want to keep it a little more private, and I kind of prefer it that way sometimes, here is an email address at the bottom where you can contact me and say, I don't like this, I do like this, it's fair, it's unfair, what about this other idea, and so forth. I'm always open to hearing different suggestions. Okay, now once I get through this slide, let's go back and talk about what happened. We're right at the open, and it looks like my cursor is different today. All right, so now we've changed it over to a laser pointer. Right at the open, and we'll go through some explanations of what happened, and then I'll go through the charts. We did have a higher open. There was some carryover from Wednesday's session. We climbed up to R1 at 53.26. And that's why I use these intraday pivot points so much, because that's where we hit. And then we started to come back down. We declined to the unchanged level, and we kind of chopped around the unchanged level for a while. And then going into the close, we dropped a little bit further to close negative on the day. We were down 0.21%. And volume is still below average, but we're still picking up from what happened on Wednesday. It picked up. Well, now we're starting to see volume dropping back off as a lot of the show seems to be over for the time being. We are positive with our technicals across all time frames, but as I said, we want to just see if some weakness starts to come in. We want to be aware of it and see if it's gaining any intensity. The market is still dealing with inflation and interest rates, and they're kind of calming down now that CPI was taken as more friendly, and we want to keep an eye on the geopolitical concerns. Some comments: staples continue to advance. Now, I see this as a warning sign. Usually when staples are going up, that means that the market is getting geared to be more defensive, meaning that they think we're going to go sideways to actually have a decline. That's what we saw near the end of 2021 going into 2022, which ended up being a difficult year. The utilities were down, but they're still strong as well. That's also another defensive area. But in yesterday's video, I did show a chart put out by Jason Gepfert from Sentiment Trader that shows that that's not necessarily always a bad thing. So maybe we're switching over to an environment where it's okay for staples and utilities to do well. We're not seeing growth in value doing very well right now. And that's what we were seeing since we hit the lows back in October of 2022. So we're trying to gauge the overall atmosphere of the market to see, are we shifting into a bit of a different phase with the markets where what we were watching, now we have to start watching some slightly different things to see if we can get clues whether we're going to go higher or lower. On a short-term basis, we still have a pretty long list. We have the Stochh RSI, the Williams percent R, the CCI 14 and 20, the stochastics, the slope oscillator, the boom indicator based on 20 periods, and then the RSI based on 9 periods. And not a real big change to this chart, even though we did pull back a little bit. And again, as I always say, yeah, we're overextended to the upside. That part is a fact. Whether it's going to produce a pullback of any significance, or is this just showing good momentum as we're going higher? Because these are pretty touchy indicators and they get to an extreme reading fairly easily when we're moving. That could also be more the positive side of things if it's showing good momentum. In the intermediate term, the CMB composite is still extreme negative. Standard deviation, we're still up into that +3 channel, the TTM squeeze, the Sean trend meter, and then the 10-day moving average of the highs and lows for the S&P. On a long-term basis, we're still looking extreme with the 150 and 200 period simple moving averages. I haven't changed this since the previous video, but I did change it a little bit this week. It is looking like the Fed's going to keep rates higher for longer because inflation hasn't been coming down the way they were hoping it would. And we're kind of unsure about the timeline for rate cuts, but now the market is starting to anticipate September. And that's going to change every day. And that's going to change as economic reports are released. And I'll be going over this in the weekly video. That's when I go through and show what the probabilities are for the upcoming Fed meetings. I usually only look out to the next meeting and then the one after. Well, now I'm probably going to start to include September in that analysis because the market has been focusing on that. And then at the FOMC meeting past, they did announce that they are decreasing quantitative tapering. And that is where a lot of the thrust has been coming from for the market. The market likes that, and it's been going up since then. The dollar was up and interest rates were also up. This put some pressure on stocks. We closed at 4.38% for the 10-year yield, where we had been at 4.36%. We're still inverted with the yield curves. Sentiment didn't change. We're still coming in at 60. It's positive for the time being. We are now starting to develop a trend with the ADX crossing above its moving average. We're still waiting to see if they can cross above 20, and I'll show you those charts. With the slight down day that we had, and it was down less than 0.25%. The bias is negative. Usually if we have an up day, it's positive. A down day is negative. Sometimes when we're virtually unchanged, I may leave it what it was before. And momentum still continues to be positive. Economic reports, and there's a whole list here, but I'm not going to show charts to all of these different economic reports. Usually the ones that I do show if you've been watching the videos for a while. We came in at 222,000 for initial jobless claims, a little bit more than the 218,000 they had expected. Continuing claims came in at 1.794 million, and I'll have charts to show you this. Housing starts came in up 5.7% on a month-over-month basis. When you annualize that, that's 1.36 million units, less than the 1.44 million that they had expected. Building permits, and this also looks out into the future, they were down 3% on a month-over-month basis. Annually, that's 1.44 million. They expected 1.48 million. So this was a little bit soft with both of these reports. And then I'll show you the charts for the ones I just talked about. Import and export prices, I'm not going to show charts of those. They were up 0.9% month over month. And you compute that out, that's 1.1% on a year-over-year basis. If you take out fuel, they were up 0.7%. If you annualize that, it's 0.9%. Export prices were up 0.5% month over month. They're still looking at declining on a yearly basis of 1%. If you take out agricultural products, they were up 0.7%, and then on a year-over-year basis, up 0.1%. The Philadelphia Fed Index came in at 4.5. They expected 5. Last time we had 15.5, And anytime we see something above zero, that's showing expansion, but it's not as much of an expansion as what we saw last time. Total industrial production, and I do have charts for this one, was unchanged on a month-over-month basis. They expected it to be up 0.2%. Last time it was up 0.1%. And capacity utilization, we're still under that 80 level. Usually when we're at 80%, that means factories and companies are operating at full capacity at that point. That's where capacity utilization. So it came in at 78.4 as expected, and last time it came in at 78.5. Total industrial production was down 0.4% year over year. The long-term average is up 1.2%. Okay, let's look at some charts. Here are the weekly jobless claims. They did decline from the high reading that we saw a week ago, but the moving average is still continuing to go up. And this is suggesting possibly some weakness looking, this is a little bit more forward looking because it's more closer to now when this information is released. And even this is delayed a couple of weeks. You can see up here, actually a week. It's dated May 10th, but we just want to keep an eye on this. And then the continuing claims are also going up, but we're flattening out a bit with the moving average. And then I put everything here on one chart where in red are the initial claims, in blue are the continuing claims, and then the latest unemployment rate is in black. To make it a little easier to see is that same thing, because we had that huge spike due to the COVID lockdowns. And looking at housing starts and building permits, now what they do here is they take a 3-month average. And the starts, that they're beginning to build something, that actually declined a little bit. And then building permits, because you have to go get the paperwork done to do that. That's the yellow line. It's also declining. And then housing starts, we did come up a bit from the previous reading. Production and capacity over on a year-over-year basis, where we're showing capacity utilization, it's this yellow line and pretty much going sideways. And then production is actually dropping off slightly. We look at capacity utilization, we're still above this 80 level. This is usually where we top out. Well, it's coming down, but not really falling apart at the present time. Industrial production on a month-over-month basis, it did decline, but it was still positive. And then some blog charts. Now, this chart is kind of interesting. In the online class that I have on the YouTube and Rumble channels, I put a free class up there. It's a few years old now. I'm re-recording that as I'm getting ready to launch the program. It's designed to be for beginners. And I kind of want to have a bit of a takeaway from that class. Maybe if you're a longer term investor and you might use mutual funds or ETFs in your portfolio, this is, I call it SMAC, the simple moving average crossover system. And basically you go long or you get into mutual funds that are buy low and sell high when the red line crosses above the black line. And then you either get out when the red line crosses below the black line, so you can avoid some of these really nasty downturns, or you might have access to inverse mutual funds, which actually go up in value as the market goes down. And the program that I have, this not using just this moving average crossover, but when I first started this in the late 90s, early 2000s, really I only had mutual funds available to me, and it was a company called Ridex, and they had juiced mutual funds that you could get into when we were going up. So if the S&P was up 1% and you were in that mutual fund, you would be up 2%. And then they also had inverse mutual funds. So if the S&P went down 1%, that mutual fund would actually go up 2%. Yeah, that sounds all good and juicy and nice and everything like that. But when you're wrong, it can really give you a pretty big hit at that time. Now we have inverse ETFs and juiced ETFs and so forth. But this is a really simple system that a lot of people do. And this is just a 50-period moving average over a longer term moving average. Now, they don't actually say what this is, but the system that I use, it is a 50-200 crossover. All right, then bull markets last longer than you think. The average here is 61 months. And up to this point, when we bottomed in October of 2022, we've been into this for 19 months so far. And then this is a projection from Goldman Sachs where, and again, the current rate and then what they think we're going to be at the end of the year, we would actually have to decline to get to their target rate. And then risk appetite is starting to increase. Folks are willing to take on more risk as the market's been going back up. And then this is what people are expecting the performance is going to be over the next 30 days. They think that the market's going to go up as well. And then the global growth expectations, they're actually starting to fall a little bit here. So we had been seeing a bit of an improvement. The light blue line, this is the S&P 500, and this is just a percent of people that think the market's going to get stronger, or the economy is going to get stronger. That's been decreasing as of the time this chart was created. And then they're still pricing in rate cuts. There's nearly a full cut, 20 basis points. A full cut would be 25 basis points because they do it in 0.25% increments. And even though we're going down a little bit here, they're still anticipating that the market is anticipating that the Fed will be cutting rates at some point in 2024 based on how things looked right here in late April. And then by sectors, you might want to pause this and look at it, just seeing what are the biggest inflows that we're seeing into these different sectors, where discretionary saw the biggest outflows. And that a lot of that has to do with Tesla. And that sector, which usually helps us with it's kind of like a buy low, sell high, growth value type of thing. These are things that make life fun. And Tesla's been under pressure, so a lot of people are getting out of that particular sector. A lot of folks are doing ETFs. You might just get into SPY or the QQQs or the diamonds, what have you. And then the different areas that folks are getting into these days. And then this is sentiment. It's showing some improvement here, put out by Bank of America, but this was as of April. So this isn't really including May. So it's probably going up from here as we've been bouncing back up. And then we usually get this whenever retail sales comes out, and we've been keeping an eye on this. You see these red arrows. Usually when we flatten out, when we're looking at retail and food sales, that's often before we go into a recession. We've seen that. It was back here in 2001. And then we saw this going into 2008. Well, we've been flattening out over here, but we're not necessarily going into a recession right now, but we still want to keep an eye on this. And then looking at the 12-month and 24-month forward world stock valuation, looking out over the next 12 months, they have us coming in with a ratio of 17.6%. And then looking 24 months, 2 years out, they're looking at 15.7%. So you look at this, and the market isn't necessarily overvalued on a global basis, but we're getting close to that 20 level again, even looking forward, especially with the S&P. The mid caps and small caps are a little bit more fairly priced, but when we're down around the 15 area, that means we're fairly priced. If we get down to 10, that's when stocks are considered to be inexpensive or actually cheap at that point. And some folks use this as a way to make decisions. Now, I don't. I want to know what's going on here, and it's good to be aware of these things, but they're not necessarily used to make decisions because especially in the U.S. markets, we can stay overvalued even with forward PE ratios for a long time. Some charts. This is Sentiment Trader again, put out by Jason Gepfert. He had a really useful chart that I'm probably going to use in the What to Watch video. But it says earnings season for the S&P 500 companies, it's about 87% complete, and it's looking pretty good. Reporting earnings are on track to grow 10% from the first quarter of 2023. They look at it on a year-over-year basis here. The first back-to-back quarterly increases in a couple of years. And you'd think this would be positive, but it says the cruel irony of markets is that what's obvious is not often helpful. It should be obvious that earnings growth is good for stocks, and double-digit growth should be even better. But looking at this, it's not always been the case. He has, when we get above 10%, when we're into the 9% area, that seems to do better. But we jump above 10%, which is counterintuitive. We see kind of okay returns here, and how much of the time they're actually up. The stats are not necessarily all that strong. Then I don't pay attention to him. I've read some of his books, but a lot of people do. This is Ray Dalio. and he's the manager of one of the most famous hedge funds called Bridgewater. And when he talks, people listen to that. I just kind of take it as something interesting because I like to reach my own conclusions. He warns of danger of U.S. debt to Treasury market. Now, okay, we've been talking about this for a number of years already. And the fact that this is coming out right now is not necessarily cutting edge news. But at the same time, there are a lot of people that quote him and listen to him, just like they quote and listen to Warren Buffett. Here's a headline that I saw: next Japan intervention. And I've been talking about this off and on for about a year to year and a half. We're keeping an eye on Japan because they are the biggest owner of U.S. treasuries. And if they start running into trouble over there, they're going to have to possibly sell those treasuries. And since they're the biggest owner of treasuries, when they sell, that pushes prices down and interest rates up. So that's why we've been keeping an eye on that. So the next Japan intervention likely to use treasury sales, Bank of America says. Now, we don't know. Japan likely stepped in to support the yen in recent weeks as we've been seeing the yen bouncing back up. Future intervention to come from T-bills, not cash. Now, this is according to Bank of America. And that could end up being negative because if we see interest rates going up because treasuries are going down based on price, that could have an impact on the market. Also, Edward Yardeni, this is one of the few economists that I actually respect and listen to, because some of them, it's like two economists can have a discussion and they can come up with like 5 conclusions. But I've read his books. Some of the charts that I use over the weekend based on forward PE, they come from his website. I sometimes watch his videos on YouTube, and I would recommend him to you. He's one of the more sane economists. I know that's an oxymoron, but Yardeni warns of S&P melt up if Fed makes a mistake and cuts rates. He thinks cutting rates right now would not be advantageous. The market would have a positive reaction to that, and it would shoot up, but it would lead to kind of like a blow-off top at some point. Then, looking at our charts here, where we did have a higher open, there was some follow-through after Wednesday's move up. We came right up to R1. The cool thing about these pivot points, they're on the chart before the day even opens. That's why I post them on the YouTube community tab. You can go ahead and look at what the pivot points are going to be for Friday's session, and then this gives you a good idea of different resistance levels when we're going up and support levels when we're going down. But we came up to R1, then we drifted back down, kind of danced along the unchanged level, and then saw some weakness going into the close. Here's our intraday chart. Really nothing all that major happening here. We're coming down a bit now with large cap growth, where it had been the blue line had been above the red line. Now they're both starting to decline. And we saw a bit of a decline here with the growth to value ratio for the S&P with a down day. We were down with growth where value was up for the large caps. It was down more for the mid caps and down more for the small caps when we compare it to value. So our end of day chart's not really seeing any strength here. And that's what's making me wonder, are we shifting the climate a little bit here, where maybe staples and utilities, they can do okay, and maybe growth to value, it hangs in there and it's positive, but it's not outperforming like it was before, where our ratio is just not showing much of an improvement with the small caps, the mid caps, and even with the S&P growth to value ratio on the end of day charts. Coming down just a little bit here with the growth to value ETFs that we do a ratio between. We're still inside of the rainbow. Discretionary, not showing an awful lot of strength now either. When we look at the ratio between discretionary and staples, large cap growth did decline after setting a new all-time high in Wednesday's session. The Wilshire also saw a bit of a decline. And looking at our trend, we're just a little bit under 20 right now. We're trying to cross back above it with the intermediate term chart. We are now getting above the moving average, and the green line is on top. So we would default to positive. But some of you may have already said we're in a positive trend. Others may want to wait and say, no, I want to wait until this actually goes above 20 to confirm that. Where we are above 20 with the short-term ADX. So this is now a positive strengthening trend environment. But we continue to be below average with volume. Looking at sentiment, we're still kind of going sideways, but below the moving average with the Ulcer index. And we did have a reading, but this is now a couple of days old. It came out on May 14th, where the investors' intelligence is at 3.19. That's a little bit leaning to the positive side, but not necessarily extreme. We did actually decline a little bit here with the VIX, with the line chart as well as the bar chart. And we're kind of going up a little bit here with the VIX of the VIX, both with the bar chart and the line chart. The momentum for the VIX still continues to be down. And we came up with the equity put call ratio. And we're just ticking back up just a little bit with our 5-day equity put call chart. We'll want to see is if this is going to continue to go back up. That would end up being more negative for the market typically. And the volatility risk premium, after coming right back up to the band, did decrease in Thursday's session. We are continuing to decline with this fear gauge, and the other fear gauge is also declining. So sentiment is still looking positive. We did get the latest rating of the American Association of Individual Investors. Not much of a change. They're still positive overall. But looking at our charts, we're still looking okay here with the advanced decline line based on price and volume. And actually, volume seems to be holding up a little bit better. Still looking good with the new highs versus new lows. We came down with the down day, but they're still a lot stronger than the new lows. We're still going up with the 5-period and the 10-period moving average. We're still positive with the advanced decline ratio. We ticked down, but we're still above the moving average with accumulation distribution. We came down a little bit with the Chaikin money flow, but we're still positive there. Chaikin oscillator ticked down, but it's still positive. And when we look at the cumulative NYSE advanced decline line, it came down slightly, but the regular NYSE advanced decline line is still holding up fairly well. And this other NYSE advanced decline line also is looking healthy for the time being. We look at NYSE common stock based on price. That's still looking positive as well as volume, even though we ticked down on both barely. When we look at the advanced decline line on a cumulative basis for the S&P based on price, that's still looking good as well as volume. We're still looking good with our advanced decline line studies across all the indexes. Here's our short-term chart looking at, this is a daily chart. Actually, it's not really short-term, it's a 3-year chart. We're still looking okay here. We might run into some overhead resistance at some of these previous points if we go up. If we start to fall, we'll be looking for one of these pivot points actually acting as support. And we're also getting further above the 50-day moving average. Looking at the bottom, we are still below average with volume. The Stochc RSI, the Williams percent R, the CCI 14, the CCI 20, and the stochastics. Those are all extreme positive. And with the stochastics, they're still extreme in the short, intermediate, and long term. The boom indicator still looking extreme, measuring that we're getting kind of far away from that 20-period moving average. We're just under looking extreme when we measure the distance away from the 50-period moving average, and we're still going up and looking healthy with the 200-period moving average study. When we do a double and triple exponential moving average based on 20 periods, we're still looking positive here. The 20, 50, and 200 did, the 20 and 50 ticked down, and we're flattening out a bit with the 200 moving average. We ticked down a little bit with the force index where it had been extreme positive. It came down slightly. Looking at our 20-period moving average, we're still looking healthy here. We're into the +3 channel now with our standard deviations chart. That just means that we've gone up kind of far, kind of fast. We're still looking positive, even though we declined with the balance of power. The go, no go is positive. The highest high value is positive. The TTM squeeze is positive, but getting above this black line that I put here, so it doesn't mean that it's gospel or anything like that, but we are looking extreme positive there. With our 50-period double and triple exponential moving average study, we're still looking good. The longer we can stay above both of these lines, the better chance we have of the red line crossing above the blue line, and that the red line moves faster. CMB composite, even though it declined, is still extreme positive. The 50-period moving average, we're still looking good there. The ease of movement ticked down, but it's still positive. The Arun is still going up and has turned positive. After being extreme with the S&P McClellan oscillator, we actually came down a little bit and are no longer extreme. But because we're above zero with the McClellan oscillator, the summation index based on price and volume continued to advance. The NYSE McClellan oscillator also declined, but we're still above zero. So the NYSE summation index based on price and volume still are positive. We're declining with the Swenlin trading oscillator based on price, and we're rolling over just a little bit with the Swenlin trading oscillator based on volume. Again, a potential warning sign here. We just want to keep an eye on this. But on a momentum basis, the PMO is positive. When we break it out based on price and volume, that's positive. We're still looking okay, even though we tick down with the percent of PMOs that are rising. The buy signals are still going up, and we're still showing some improvement with the PMOs that are above zero. The Elder's impulse system has switched to neutral after being positive for the S&P. We're still positive with the parabolic SAR. We're still positive and possibly extreme positive with the slope oscillator. The MACD is still looking positive, and all of our oscillators, short, intermediate, and long-term, continue to be positive. And we're still above all the plotted moving averages here in our moving average tree. The bullish percent index isn't up to 70 yet. It's still hanging in there and looking okay for right now. We're continuing to go up with the NYSE bullish percent index and also advancing with the NASDAQ 100 bullish percent index. The money flow is still positive and above 50. We're declining with the ultimate oscillator, but still above 50. The vortex did decline, but the green line is still on top. That's positive. And we ticked down a little bit with the RSI 14. We're ticking down also with the RSI 9, but we're still extreme positive there. We're still looking okay with the on-balance volume. We ticked down a little bit with the stocks inside the S&P above their 20-period moving averages, but we're still looking good there. And so we did make this thrust up above 70. So when other times when that happened, good things ended up happening after that. Now, we don't know if that's what's going to happen this time, but we have some precedent on the side of this ending up being a good thing. The 50-period moving average steady did tick down, but we're above 50. We're flattening out with the 100-period moving average steady, but still positive. We're coming up still with the 200-period moving average steady and just under 80%. When this gets above 80, that means 80% of stocks inside the S&P 500 are above their 200-day moving average. The Copic curve is still positive. The Sean trend meter now is starting to get extreme positive. And here's our Ichimoku cloud where we have the blue line above the red line. That's positive, and we're coming up out of the cloud. And I'm probably going to drop showing this if we continue to hold up fairly well. I keep showing this chart because it's a new one that I just added this past week. Standard deviation is declining, but we're still above the moving average. The Pring bottom fisher is still on a buy signal. The mass index, again, not sure how to interpret this. I was interpreting this as negative because the context was that we were going up as this was being triggered. This looks for a reversal, and so you would have thought that maybe we were going to see some kind of a downward move. But we haven't seen that with any conviction, at least yet. We are still positive with the Heiken Ashi. We're positive with the Kegi chart. We're positive with the Renko chart. We're positive with the three-line break chart. And then our longer-term moving averages are still looking quite positive, maybe too positive, based on 150 and 200 periods. Looking at our indexes, we are still positive across the board, across all time frames. We're still negative in the intermediate to long term with bonds based on price. Commodities recently switched back to positive. The dollar is in a short-term downtrend. No change yet on the decision point scorecard. And we saw a lot of this happening right after, well, the first hour to hour and a half of the day, where the S&P did set a new all-time high. That was an intraday high. So did the Dow. So did the NASDAQ. The Dow was above 40,000. Everyone was all wild about that. But the utility sector, again, set a new 52-week high. And the industrial sector had a bullish percent index cross below 70. That would be more like a sell signal. And looking at our sectors, where staples and financial, they were virtually unchanged, but staples are still doing well. All of the other sectors ended up being down on the day. I'm not really seeing much of a change here between the S&P 500 and the S&P 500 equal weight. We were down just a little bit with our ratio, and we're just really chopping around right now, where we're not seeing any big up moves or down moves like we were seeing before. The Dow did set an intraday high, but ended up closing lower and is still looking good. We've turned to neutral from positive with the diamonds for the Elder's Impulse system. It came down just a little bit with the NASDAQ after setting an all-time high in Wednesday's session. Same thing with the NASDAQ 100. It was down slightly. We're still positive with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 continues to be positive, and we're still above the moving averages when we also look at the QQQs. Small caps, yeah, they're just at the higher end of the range that they've been in pretty much for all of 2024. We want to see a breakout to get more positive on this part of the market. And we've turned over to neutral with the Elder's Impulse system for the small caps. Looking at the Russell 2000 small caps, we're declining after getting above 70 with the RSI. We're still in a longer-term uptrend, and shorter-term, the momentum continues to be positive. The mid caps also declined, but they're still above this R1 pivot level. And we've turned over to neutral with the mid caps when looking at the Elder's Impulse system. Apple was virtually unchanged, but up slightly, and it's trying to climb back above its 200-day moving average, but it's still in a downtrend. Tesla was up 0.5% and kind of dangling around its 50-day moving average, but also in a downtrend. NVIDIA was down slightly, but still above its 50-day moving average. Microsoft was down 0.5%, still above its 50-day moving average. Meta was down 1.73% and not quite getting back to its 50-day moving average. Amazon was down 1.27%, but still above its 50-day moving average. So you see some profit taking in here. Google was up almost 1% and coming back and potentially setting a new all-time high. Doesn't look like that happened on a closing basis. It might have happened on an intraday basis. The FANG index saw a little bit of a pullback, but has been breaking out after it had been chopping sideways. The financial sector was unchanged on the day, but it's still positive. We're watching the staples to tech ratio, where staples had been underperforming tech. Now they're starting to bounce back up a little bit. So we're just keeping an eye on this for right now. The dollar did bounce up a little bit after it had been declining. It came down to its 200-day moving average and was able to bounce up off of that. And then I have another new chart after this. When we look at the S&P 500 and compare it with the world index, the short-term relationship is still strong. We're seeing just a little bit of a turn up here with the longer-term correlation. And here's a new chart, which takes a ratio. I look at the SPY and I compare it with the ACWI ETF. And when this is going up, that just means that stocks in the US are outperforming stocks in the rest of the world. The staple sector continues to go up and is setting new all-time highs. Utilities didn't close higher, but they set a new intraday high and set another new 52-week high. But when we look at all stocks, we are still looking good here. We were down 0.33%, but we're still well above the moving average. We were up with the 10-year yield. We were down with the 10-year price. And we're still declining with this ratio. Now, a lot of these ratio charts I'm not going to show because they declined. I only want to show them when they are showing an improvement, suggesting that stocks are outperforming bonds. But this ratio still declined, showing that bonds are underperforming stocks. And then our growth to value ratio is not seeing anything all that great. A little bit of an improvement with Qs to the S&P, still declining with discretionary to S&P, and tick down, but still above the moving average when we look at large cap growth versus large cap value. So a little bit of an improvement with the large caps, coming up to the moving average with the mid caps, and also coming back up to the moving average with the small caps. We're still looking good here. The 10-day average of the S&P 500 highs minus the lows. That's coming into an extreme positive reading. Now, you can take that as negative because we do use this like an oscillator. But since in the bigger picture, we're in an uptrend, so if we can stay up here for a while, that would also suggest good momentum in the market. We're also looking good with our 19-day advanced decline ratio based on price and volume. We're still positive with our 5-period moving average of the highs minus the lows across the broad market. This is still declining and possibly a concern as utilities are going up. This ratio is going down. What we've been seeing over the last few years is when this ratio goes up, that's when the S&P really goes up. We're wondering if that's changing to a new type of an environment. This ratio continues to come back up. It actually was declining, but now it ticked back up. Staples to S&P. Generally, when this ratio is going down, that's more positive for the S&P. So what's our outlook for Friday? We're still positive, and we still have a lot of extreme positive readings. We're going to get LEI. That's the main report. That's the leading economic index. And then we want to keep an eye on all the crazy stuff going on in the world. So we finished out the economic calendar for this week. We've also finished out this economic calendar. Seasonally, we are negative, and we're pretty negative for May 17th with the Dow, S&P, and NASDAQ. This is also going to be options expiration Friday. And now we're probably going to, I haven't looked at any weekly chart. I think it could be a real easy thing to do, but I didn't. We're probably going to be up on the week, but typically this has been a negative week historically. And then looking at the week seasonality, this is the green dashed line going into the 17th. And we might see a few more days of that until we get about into the 23rd or so, where before we see a little bit more of a bounce going into the latter part of May. And Friday is the second most positive day after Monday, based on what happened in 2023. We're still in this week time, according to Tom Bowley's research. So the warning signs, I'm not quite sure what to make of the mass index signal. I was treating it as a warning sign. We're kind of every day that we get beyond that without seeing any kind of a meaningful decline. We just saw a little tiny pullback on Thursday. This is becoming less and less relevant. And then we're still watching staples and utilities to see. Right now, it's a warning sign to us. We could jump on board and say, no, this is positive. But this is not how the market has been acting over the last few years. So we just want to be aware of this. And growth to value, as well as discretionary to staples, they're not really showing any improvement. Positive signs, I'm just going to click, 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 click as you go through all these. Even though we saw declines with some of these indicators, they are still positive together. So our conclusion, we're positive. We're still extreme positive in the short and intermediate term, and we continue to be positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day on Friday, and I will talk to you in the next video.